Question 9. Does Vanguard Extended Market ETF contribute to portfolio diversification? Yes, the Vanguard Extended Market ETF, VXF, can contribute to portfolio diversification, but with some nuances to consider. Here's a breakdown of how VXF can play a role in diversification and the factors to keep in mind. Diversification benefits. Exposure to different market segment. VXF focuses on small and mid-cap stocks, a distinct segment of the market compared to large-cap stocks that dominate broad market indexes. Including VXF alongside large-cap focused investments can help diversify your portfolio across market capitalization. Reduced correlation. Small and mid-cap stocks often have a lower correlation with large-cap stocks. This means their prices don't always move in tandem. During periods when large-cap stocks decline, small and mid-cap stocks might perform differently, potentially helping to reduce overall portfolio volatility. Nuances to consider. Limited diversification compared to total market funds. While VXF offers exposure to a basket of small and mid-cap stocks, it's still less diversified than a total stock market index fund. These funds hold stocks across various market capitalizations, sectors, and geographic regions, providing broader diversification. Concentration risk. VXF focuses on a specific market segment. If the small and mid-cap market experiences a downturn, it can have a more significant impact on VXF's performance compared to a more broadly diversified fund. Optimizing diversification with VXF. Combine with other asset classes. The true power of diversification comes from combining VXF with investments in other asset classes, such as bonds, real estate, or commodities. This can further reduce overall portfolio volatility and create a more balanced risk-reward profile. Allocation based on risk tolerance. The appropriate allocation of VXF in your portfolio depends on your risk tolerance. Investors comfortable with higher volatility for potentially higher growth can allocate a larger portion to VXF. Conversely, more conservative investors might choose a smaller allocation. Question 10. Are there other ETFs with similar objectives of Vanguard Extended Market ETF, but lower expense ratios? Yes, there are several ETFs with similar objectives to the Vanguard Extended Market ETF, VXF, but potentially lower expense ratios. Here's a breakdown of some options. Similar focus on small and mid-cap stocks. iShares Russell 2500 ETF, SMMD, tracks the Russell 2500 index, which includes small and mid-cap stocks similar to VXF. SMMD's expense ratio is currently around 0.15%, slightly higher than VXF's 0.7%. Fidelity Small Mid Factor ETF, FSMD. This ETF focuses on small and mid-cap stocks with specific value and quality characteristics. FSMD's expense ratio is currently around 0.29%, higher than both VXF and SMMD. Broader market exposure with lower costs. Schwab U.S. Broad Market ETF, SCHB, tracks a broad market index encompassing large, mid, and small-cap stocks across various sectors. While not purely focused on small and mid-cap like VXF, SCHB offers significant exposure to this segment and a very low expense ratio of around 0.3%. Choosing the right option. Several factors can influence your decision. Expense ratio. Lower expense ratios translate to more of your investment going towards returns. However, a slight difference in expense ratio might not be a deal breaker if the ETF offers other desirable features. Index tracked. While all these ETFs target U.S. small and mid-cap stocks, the specific index they track can differ in composition and weighting methodology. Researching the underlying index can help you understand the specific exposure you're getting. Investment objectives. consider your overall portfolio strategy and risk tolerance. If pure small and mid-cap exposure is your priority, VXF or SMMD might be suitable. If broader market exposure with a lower expense ratio is appealing, consider SCHB. Question 11. Could a combination of individual stocks or other ETFs achieve a similar outcome with potentially lower costs or greater control? Yes, a combination of individual stocks or other ETFs could potentially achieve a similar outcome to the Vanguard Extended Market ETF, VXF, with lower costs or greater control. Here's a breakdown of the pros and cons. VXF versus individual stocks and other ETFs. VXF. Pros: low expense ratio, instant diversification across small and mid-cap stocks, passively managed, requires minimal research. Cons: limited control over specific holdings, tracks a specific index, performance tied to the index, might not align perfectly with your investment goals. Individual stocks. Pros: potentially lower costs if you avoid commission fees, depending on your broker, greater control over stock selection, ability to align holdings with your specific investment thesis. Cons: requires significant research and time commitment to choose individual stocks, higher risk due to lack of diversification, increased portfolio volatility. Other ETFs. Pros: potentially lower expense ratios than VXF, depending on the chosen ETF, broader diversification options, beyond just small and mid-cap, ability to target specific sectors or investment strategies. Cons: still limited control compared to individual stocks, research needed to choose the right ETFs, might not perfectly capture your desired investment outcome. Building a similar outcome. Selecting specific ETFs, consider ETFs that target specific size caps, small, mid, or a blend, or specific sectors within the small and mid-cap universe. You can combine these with broader market ETFs like SCHB, mentioned earlier, to achieve a desired level of exposure. Individual stocks. Researching and selecting individual small and mid-cap stocks allows for the most control. However, remember the time commitment and potentially higher risk associated with this approach. Question 12. What are the pros and cons of this Vanguard Extended Market ETF compared to similar options? VXF offers exposure to small and mid-cap U.S. stocks, but there are other ETFs with similar objectives. Here's a breakdown of VXF's pros and cons compared to potential alternatives. Pros of VXF. Low expense ratio, at 0.7% as of March 9, 2024, VXF boasts a very competitive expense ratio. This means more of your investment goes towards potential returns compared to ETFs with higher expense ratios. Instant diversification. VXF provides exposure to a basket of small and mid-cap stocks, offering instant diversification within this market segment. This reduces risk compared to holding just a few individual stocks. Passive management. VXF is passively managed, meaning it tracks an index. This requires minimal research and management on your part. Brand reputation. Vanguard is a well-established and reputable investment firm, offering peace of mind for some investors. Cons of VXF. Limited control. VXF tracks a specific index, so you don't have control over the underlying holdings. The performance is tied to the index's composition and weighting. Focus on small and mid-cap. While offering potential growth, this market segment is inherently more volatile compared to large-cap stocks. Less diversification than total market funds. VXF focuses on a specific market segment, whereas total market ETFs offer broader diversification across various market capitalizations and sectors. Question 13. What are the potential benefits and drawbacks of investing in Vanguard Extended Market ETF compared to individual stocks within the same sector? Investing in VXF offers several advantages compared to picking individual small and mid-cap stocks within the same sector, but there are also some drawbacks to consider. Here's a breakdown. Benefits of VXF. Instant diversification. VXF provides exposure to a basket of small and mid-cap stocks across various sectors within the U.S. market. This reduces risk compared to holding just a few individual stocks, which are more susceptible to company-specific news or events. Lower cost. VXF boasts a very low expense ratio, 0.7% as of March 9, 2024. This means minimal fees eat into your potential returns compared to potentially higher commission fees associated with buying and selling individual stocks. Passive management. VXF tracks an index, eliminating the need for active stock selection and ongoing research. This is a simpler and less time-consuming approach. Liquidity. ETFs generally offer higher liquidity compared to some individual small and mid-cap stocks. This means you can typically buy and sell VXF shares more easily. Drawbacks of VXF. Limited control. You don't have control over the specific stocks held within VXF. The performance is tied to the index's composition and weighting, which might not perfectly align with your investment goals. Average performance. VXF tracks the performance of its underlying index. You cannot outperform the index through individual stock selection, which some investors aim for. Focus on small and mid-cap. This market segment, while offering potentially higher growth, is inherently more volatile compared to large-cap stocks. Benefits of individual stocks. Greater control. You can choose individual stocks based on your research and investment thesis, potentially leading to higher returns if your picks outperform the market. Potentially higher returns. By selecting high-growth potential stocks, you might achieve returns exceeding the performance of the index VXF tracks. However, this requires successful stock selection. Sector focus. You can tailor your portfolio to specific sectors you believe will outperform the broader market. Drawbacks of individual stocks. Higher risk. Individual stocks are more susceptible to company-specific news and events, leading to potentially higher portfolio volatility compared to VXF's diversification. Research and time commitment. Selecting individual stocks requires significant research and ongoing monitoring of company performance and market trends. This can be time-consuming. Higher costs. Commission fees associated with buying and selling individual stocks can eat into your returns, especially for frequent trading. Question 14. Would adding Vanguard Extended Market ETF improve the portfolio's diversification or potentially increase concentration risk? The impact of adding the Vanguard Extended Market ETF, VXF, on your portfolio's diversification depends on your existing holdings. Here's a breakdown of the two potential scenarios. Scenario 1, portfolio lacking small and mid-cap exposure. If your portfolio currently focuses on large-cap stocks or other asset classes, bonds, real estate, adding VXF would likely improve diversification. Here's why. Exposure to new market segment. VXF provides access to small and mid-cap stocks, offering diversification beyond large-cap companies. These segments often have a lower correlation with large-cap stocks, potentially reducing overall portfolio volatility. Reduced concentration risk. By adding VXF, you're spreading your investment across a wider range of companies, reducing your reliance on the performance of a few large-cap holdings. Scenario 2, portfolio already with small and mid-cap exposure. If your portfolio already includes investments in small and mid-cap stocks, individual stocks or other ETFs, adding VXF might increase concentration risk. Overweighting a specific market segment. Depending on your existing holdings, adding VXF could lead to an overexposure to the small and mid-cap market segment. This can magnify potential losses if this segment experiences a downturn. Limited diversification benefit. If your existing investments already provide some exposure to small and mid-cap stocks, adding VXF might not significantly improve diversification. Here's how to assess the impact on your portfolio. Analyze existing holdings. Identify the asset classes and market capitalizations your current portfolio is invested in. Consider overall allocation. Determine the percentage of your portfolio you're considering allocating to VXF. A smaller allocation will have a lesser impact on diversification. Use portfolio diversification tools. Several online tools can help you visualize your portfolio's diversification and assess the impact of adding new investments like VXF. General recommendations. Focus on broad diversification. Aim for a diversified portfolio across various asset classes and market capitalizations. VXF can be a valuable tool if you lack exposure to small and mid-cap stocks. Maintain appropriate allocation. Don't overexpose yourself to any single asset class, including small and mid-cap stocks. Consider your risk tolerance when allocating a portion of your portfolio to VXF. Alright everyone, that's all the time we have for VXF today on Chat ETF. So, to recap. VXF offers a low-cost way to gain exposure to the exciting world of small and mid-cap stocks. It can significantly improve your portfolio's diversification, especially if you lack this market segment. However, be aware of the inherent volatility associated with small and mid-cap stocks. VXF might not be suitable for risk-averse investors. Before you go, let us know in the comments below, would you consider adding VXF to your portfolio? Also, what other ETFs would you like us to chat about next? Thanks for joining us. We'll see you on the next episode of Chat ETF.